Well, Charlie, welcome to Rules of Investing. It's great to have you on.
Thank you.
Um, it's actually perfect timing to do this podcast. Yesterday, we found out that year-on-year inflation hit 5.1%, 2.1% over the first 3 months. Did you expect it to be this high?
Not quite that high, but the market's expectation was 4.6. It's obviously come in a little higher than that. We're seeing this around the globe at the moment, aren't we, with these much higher inflation numbers? I guess a lot of that is very understandable with regard to the reopenings and the huge amounts of fiscal transfers. But we're seeing just a whole bunch of dominoes fall into each other as it pertains to the inflation story. So obviously the war with Russia and Ukraine gave the energy markets in particular, and soon will be global food prices, certainly in Europe, a very big push. And then right on the heels of that, we've got this lockdown in China, which is obviously constricting the supply lines there again. So it's going to remain elevated for a period, but I think it's really important to remember that inflation is a rate of change concept, and so there's certainly been the price rises have been jacked up in kind of price gouging, if you will, in many places. The sustainability of those price increases, we think, is unsustainable, and certainly as central bankers start to destroy demand, and certainly what bond markets are now pricing with regard to the amount of tightening we're going to see, it will definitely kill inflation. It will probably kill the economy as well. And so that's why in this process, the bond market's looking for these very rapid rate hikes, and then not too far after that, some rate cuts. So it's really about slamming on the brakes, and then we're going to need to give the whole machine a little bit of accelerator. We do expect inflation will moderate, and it's interesting for all the kind of inflation commentary that's on at the moment. Just that rate of change, it does need to stay incredibly elevated to maintain these numbers. So we think that it will naturally moderate. I'll give you a great example. Going into the Russia-Ukraine conflict, oil was about $95 a barrel. Obviously, it spiked immediately to 130, which is scary because it touches every facet of the economy in terms of the way that we transport things. And today, it's been back at 100. It's at 101 today as we're recording this on the 28th. So it really hasn't driven on all that much from the start of the conflict. And certainly, if it just moderates and stays at $100 a barrel, then the inflationary impulse from oil goes to zero. Let alone if it actually ever falls. And we do get that demand destruction because of the way central banks are going to be operating. So, yeah, inflation certainly cause for concern. It's making central bankers do extraordinary things right after they just did extraordinary things in terms of saving us from the crisis in 2020. They've stayed in those emergency settings for far too long, and I've clearly, as the major health emergency is now past us, it's we shouldn't have these emergency settings as it pertains to monetary policy. They've essentially stopped quantitative easing now, and we will not get the same amounts of fiscal spending that we've seen, over the last, kind of 18, 24 months. So three of those big kind of crutches, I guess, that markets have been supported by and now being entirely removed, which is why 2022 is proving to be a pretty difficult year for investors, from bond markets through equity markets and a whole host of other things, ex-commodities, I guess, which has been doing very well.
Has the RBA dropped the ball on this? I mean, last year, Philip Lowe said that it would be 3 years
Were they ever
until
carrying the ball?
until they
Um,
hiked, and yet here we are today.
Look, the RBA,
It's just a completely different world.
yeah, I mean, they are, well, Philip Lowe is the highest paid central banker in the world. I would say that to date, he has not covered himself in glory. So from comments right back to, we're never going to go below 1.5% as a cash rate. Well, we got to essentially zero. We're never going to do quantitative easing. We know how that ended. We're going to hold rates at zero until 2024, 0.1%. Here we are, likely hiking in May 2022. Yield curve control, we will operate in those instruments until they mature. Well, we know that was an absolute bloodbath with the way that was handled. The RBA is governed by a board of governors. And in any other kind of corporate environment, if the board enacts a policy, then it would require a board change to remove the policy. That's just standard process. With yield curve control, Governor Lowe decided not to enact yield curve control at his discretion. I wasn't aware that was even possible, but apparently it is, and there has been no real investigation, as far as I can see, as to the way that was all handled. But I think they're both sides of politics are committed to reviewing the RBA. But yeah, absolutely. I mean, look, I am sympathetic to the fact that the Ukraine-Russian crisis wasn't in everyone's estimations for this year, and it certainly changed things very quickly. But I think, even without that, it was absurd to think that we'd be in 0.1% settings, in terms of monetary policy all the way through to 2024. The economies around the world generally got through COVID pretty well. There was obviously a tremendous amount of fiscal transfer, which helped to bridge those economic issues at more than $20 trillion. It's no surprise that everybody wanted the same things at the same time when they were locked at home. There was obviously a huge demand for goods and not much demand for services other than Netflix and Uber Eats. But now the economy is reopening. The demand for those goods is dissipating quite quickly, and anyone that knows much about supply lines, there's this great kind of terminology which is called the bullwhip effect, where things can go from deficit to surplus very, very quickly. And so, a classic example: a lot of my friends who run businesses, if they were getting a 30 or 40% allocation of what they were ordering, well, invariably they order 3 times as much, and then they get what they need. But one day, 3 times as much turns up, and you might not have the warehousing for it or the ability, and invariably you need to discount hard to get rid of the excess. So capitalism is very good at solving these issues. I think if you look at things like freight rates have started to collapse, notwithstanding the Chinese ports are closed down at the moment, but capitalism responds. So the number of entities that have registered themselves as trucking businesses in the United States is up 30 or 40,000 or something like of that magnitude. You can bet your bottom dollar that every rusty truck sitting in a field has been mobilized to cash in on these exorbitant freight costs, and if I can make money just driving around, why wouldn't I? Because it's a lot of money to be made. Well, there's a lot of people collectively doing that all at the same time, and now freight prices are coming down very quickly. So, again, with this inflationary kind of issue, yes, there's definitely been very large price rises in a number of things. Yes, there is still restricted supply in a number of things. We need to think through energy policy and these types of things in a very different way looking forward. But we do not believe we're in a new secular inflationary world where this will be sustained on an ongoing basis, particularly if central banks are credible in fighting it as they're kind of promising to be, that they will do everything in their powers by slamming on the brakes of monetary policy. We know in very indebted societies that has a tremendous impact, and there will be no argument to the fact that if mortgage rates go from 2 to 5, anybody that has a mortgage spends a lot less because a lot of their income goes on servicing those much higher funding costs, and that means that every business around where we are today sells less coffee, sells less avocado toast, less holidays get taken. All discretionary spending is affected. The economy slows down, and things heal in a more brutal way. But it is a blunt instrument, and it does work. And central banks certainly at the moment look like they're they've got the stomach to do this. Whether they maintain the resolve once we get into a negative growth environment, which is almost certain if we are to believe that these policies will be enacted as the way that they're being delivered to the market in terms of central bank speeches and the like, that's another question. So. Or do central bankers then, kind of run for the cover of, inflation is falling, it's falling quickly, we believe we've done enough. They are pretty prone to changing their tune as it suits them. So, at the moment, we've got extraordinary things priced for some of these markets. I think, as we sit here in Australia today, the bond market is pricing the RBA to hike rates higher than the US Federal Reserve. Now, that's extraordinary, but it's very real. Kind of speaks to the size of the sell-off which we've seen in terms of Australian bond yields. It speaks to the incredibly poor handling by the RBA of the yield curve control moment, and a lot of international investors having their fingers badly burnt in that process, and they won't come back and invest here. It means that every Australian citizen listening to this podcast is now facing high funding costs on our national debt because we have pushed those investors out of the market, and that's not a good thing as an Australian citizen. So there is a real cost to bear here, and obviously we do have a very large debt burden that requires constant financing. We have been in structural deficit for a very long time, and we will continue to be in structural deficit for a long time. So we're very contingent on financing the country's needs, via borrowing money. We spend more than we earn as a country, so those interest rates do matter, and this is where the poor handling by the central bank really does need investigation, because it's look, bond markets around the world have sold off, but Australia has sold off so much more than others, and it's not really justified in terms of the fundamental that we see. We don't have the inflation issues that others have got. We've certainly got our own inflation issues, but we don't have 9% inflation like the US. And we don't have the wage inflation story either. And part of the reason for that is that in COVID, a lot of US workers were simply fired and then rehired as the economies reopened. Whereas here, clearly people were, put on ice via the JobKeeper program. They didn't have to reapply for their job once, we did reopen. And so we just haven't had that wage push in the same way. Now, that's not to say that wages aren't rising. They are. And I think, you will see more talk of that in time, particularly as some of these, accords get, reset and the like. But we just don't face the same issues as some of these other nations with regard to how much we need to do to address the imbalances, and yet the bond market's saying that we're going to do more than others. So there is a bit of a discourse in that.
How culpable are central banks for the inflation we see today, with all the QE, all the helicopter money and liquidity they've pumped into the economy? I mean, if blame is to go anywhere, is it the central banks?
Yeah, I mean, absolutely. In part, absolutely. I mean, it's a very complex ecosystem, as you can imagine, and it really was the combination of those fiscal transfers combined with the most extraordinary monetary policy, we've ever seen. But they've left us in this emergency state for far too long, and clearly, once the economic emergency was passed, and that really, for most of Australia per se, was just really March and April of 2020. And then, here in Victoria, we were locked down for a long time thereafter, but plenty of other parts of the country were not. And yet we had these extraordinary settings, and we still have them as we sit here right now. And so that is, a problem, and certainly has heightened the inflationary environment as a result. But it is complex. Obviously, the global supply chains have been, all over the place with regard to, shutdowns, reopenings, shutdowns, and the like. I think, clearly there'll be plenty of supply managers that will no longer have a 95% supply line straight to China, and that will change. But the whole talk of total deglobalization is a little bit premature. I don't think we'll be making everything right around the corner just yet. But, clearly we'll be looking for differing supply sources and making sure that that's managed in a better way, so that we don't have that singular reliance. And I think, given what's going on with global conflict at the moment too, there needs to be a much greater reassessment of, what are these supply lines really look like for us? For instance, until recently, Australia has only one petrol oil refinery capability. I know the government's committed to more, but in terms of things like our strategic fuel reserves, we've only got 45 days of fuel. So on the 46th day, you can't harvest crops. That's absurd. I mean, if the first thing you do if you want to have conflict with Australia is you bomb that refinery and see you later. We'll see you guys in 46 days.
So we just don't have those strategic
Well,
reserves.
it's just, these things have just not been well managed and well planned. And now, of course, as the tide's gone out rapidly and everybody is thinking through what would I actually do if I have to fend for myself, we're in an incredible position here where we have pretty much everything that we need. So we've got to set it up right and make sure that that is sustainable, over the medium term. I think, clearly, as others have found, you can't be entirely reliant upon those what are currently friendly neighbours who might not be so friendly, in future times. Look at Germany, for instance, with regard to their energy needs coming straight through from Russia, and that incredible reliance that they have on Russian gas. So, these issues are all being kind of debated and furiously at the moment. And of course, as those capabilities are being, engineered, it changes the global inflationary environment a little bit. No longer can we get everything globally sourced at the lowest possible point of the production global in terms of the global cycle. But I don't think it means that we're re-onshoring absolutely everything either. It just means that we do need to do a bit more planning and clearly balance that in a better way.
So you think globalization has well and truly peaked, and countries are going to be much more economically isolated moving forward?
Look, I mean, I don't know that it's a peak and then it needs to necessarily fall away tremendously, but yeah, to some degree, globalization probably has peaked, and just sourcing things from the lowest possible producer is no longer security viable. So in that regard, yeah, it has. That doesn't mean that it's goes from 1 to 0. It's not binary. It's not over, but it's changing. And clearly that can generate more inflation. We know that globalization and the importation of very low cost product and low cost labor pushed pricing down, and certainly with a whole bunch of other things in the secular world, very high debt burdens, demography and these types of things. It was a fairly low inflationary kind of period. Now, I guess don't forget that, after these enormous run-ups in inflation, as I said, unless those prices continue to increase at the same rates, then inflation headline numbers will fall. So what the markets are really searching around for now is, what do they fall to? They're not staying at 9 in the US. So are they going to go to 4 or 5? The central banks want to see them back at 2 to 3. They're not going to get there in any kind of specified time frame over this year. But, if we get a situation where oil, for instance, if it's making some really interesting chart patterns at the moment, it's either going to reaccelerate to higher prices, or it's very likely going to fall back towards about $80 a barrel. If that is to be the case, some of these things that have already been running really hot in last year, if we think about US inflation, the single largest driver of US inflation was used car prices. They were up 40.5% year on year. So far this year, they went flat in January. They were minus 2.2% in February. They were minus 3.6 or 3.7, I think, from memory, in March. And they're down again at the start of April. Now, that is rational. Of course, when COVID was terrifying, you didn't want to jump on the train or the bus. Having an old used car and driving yourself was a good way to protect yourself. All of a sudden now, gasoline prices very high and used car prices up 40.5%. Not everybody wants, a rusty old used car. And prices are moderating. And clearly, up until, I guess, China had been frustrated, supply had been increasing and those types of things. We'd been building a lot of new cars again. So that kind of thing does take a lot of the tailwind out of those kind of inflationary stories. But, it has been fairly broad-based. I think, there's an old saying, I guess, in the markets that nothing kills high prices like high prices. So, I think after we've all been locked on our couch and everyone's experienced some version of this with lockdown, you'll pay anything to go to a restaurant and have a meal and a drink, and the restaurant, responds by putting its prices up, and you'll accept that to a point. If they put them up every week, at some stage you stay home and have tomato pasta, and you're back on Netflix because, it's not sustainable. So, whilst everyone has used this opportunity to drive prices higher and getting a lot of these kind of one-off increases, the sustainability of that, particularly, and there was obviously an issue with regard to the borders being closed and us not being able to receive, all of the student labour, for instance, that, had done a lot of those lower paid tasks. Clearly with the borders now reopening, the labour force is normalising to look, more like it did in 2019. So a lot of that sting does start to dissipate, but the rate at which it dissipates and we get back to a more stabilised inflationary regime is really what the markets are debating. And there's almost no question that it's not going to be a smooth transfer. This is, these volatilities in this economic data series are going to remain for quite some time. You've only got to look at, China locking down and the disruption to the supply chain there again, which is just going to give us this, stop-start type of data flow, and we're not going to get to trend for a little while longer.
Yeah, I've just moved house recently, and I moved and then found out that there's a 2-month wait on beds.
Yeah, right. So how is the floor going for you then?
I found a solution for the interim. Now, the yield curve inverted much earlier this tightening cycle. What does that tell us about the trajectory for rates? Are we in for a harsher but shorter bear market this time around?
So yield curve inversion has been the precursor to every recession except 1967, where there was an inversion which didn't follow on to become recessionary. It inverted in before the recession of 2020, which was obviously incredibly short. How the hell did it see COVID? Well, of course it didn't. But the markets were slowing already. If you remember at that time, We'd had, we'd got to 2.5% Fed funds in the fourth quarter of 2018. The bond market had a large sell-off in October of that year. Credit markets completely froze in November 2018, and there was no debt capital markets issuance globally in high-yield bonds in November. Now, that's not people trying to borrow new money. That's people that also need to refinance existing obligations. So, those bonds they're like a mortgage that need to be raised every few years. You don't get 30-year debt, if you're a high-yield corporate. So that clearly, is the real, financial oil of the economic machine. And when, you think about, the Russell 3000, for instance, 20% of its members essentially are zombie corporations. They are completely contingent on debt capital market financing to exist. And so once you get those blockages, then it becomes chaotic. And we had a 20% drawdown in equities in December 2018. That took the Federal Reserve from being in hiking mode to patient on the 4th of January 2019. So that big shift in policy. And they were cutting rates again pretty much at the insistence of Trump by July of 2019. But the economy wasn't going great. And that's why we'd essentially seen those inversions. This time around, it's extraordinary how fast things have evolved. The speed of this has just been absolutely unprecedented. In the rate hiking cycle of 2004 to 2006, the curve didn't invert, I think, until the 15th rate hike.
The 15th.
The 15th.
It's already inverted.
Right? In 2015, it was very slow. So we had one rate hike in 15, one in 16, 3 in 17, and 4 in 18. The curve inverted after the 9th rate hike. This time around, we inverted 13 days after the first rate hike. So this is utterly extraordinary. And essentially, we've priced in what is a full rate hiking cycle. And the estimations here, as we sit here today, the estimations for 1-year rates in the United States is to be at 3%. We're at 50 basis points today. So another 2.5% of tightening. In 1 year's time, the estimations for Australian interest rates is nearly 3.2%, higher than that of the US. So, we're talking about 13 or 14 traditional 25 basis point rate hikes. For most people, we haven't had a rate hike here for more than 10 years. There's a hell of a lot of people with a mortgage that have never even experienced having to pay more. They've very much enjoyed having to pay less, and they've spent the difference in the economy, and it's been very virtuous. But it works perfectly in reverse, and it does generate a bit of a downward spiral. And so if we are to realise these things, I don't think a lot of people will argue with me that, clearly the economy changes very quickly, housing changes very quickly, construction changes very quickly. You're going to build something to be delivered into a market that could be 20, 30, 40% lower on delivery? No. Is everybody employed in the same way? No. So it's hard. Of course, it's possible. Is it probable? No. And so, will these forwards be realised, or are they very generous? I would say they're very generous. But again, until we get more, certainty with which how will the inflation environment settle down, I think it's rational that bond markets are kind of asking these questions at the moment. And I kind of remind folks that bonds, particularly government bonds, are the locomotive at the front of a big train of assets, and invariably where they go, a lot of other things will be taken. So that worked beautifully as rates went from 15% to essentially zero. And as the discount rate or the funding rate on thousands of things, they enjoyed, vast, revaluations to higher prices, and everybody very much enjoyed that. But sadly, it does work in reverse. And so as these markets have now risen in yield, again, that does bring into question, what are the discount rate assumptions that are used in a lot of these private assets, in real estate, in equity market, discount rates and the like. So it does set up for a difficult environment. But the thing that actually brings it all together is the credit markets. And so, as I said earlier, with that freezing of the credit markets in November 2018, it's very difficult to ascertain when the markets will lose confidence in some particular names in credit. But when it does, it becomes very infectious. And so, clearly that moment is ahead of us still, because the refunding burdens become just simply too much. And for those that are on the weaker end of, the credit markets, when we get these much, much higher realised interest rates and they go to refinance, it's just a bridge too far. And then clearly that becomes a pretty volatile moment. And as we know, when credit does underperform, it tends to happen in a very chaotic way. And it's a real kind of crescendo moment. It's not an orderly process that, credit spreads just widen bit by bit by bit. And it's important to think about what is a credit spread. So, and why do they behave in this way? If you think about an Australian government bond that yields 5% and a BHP bond that yields 5.5%, well, then that's the market ascribing a 10% premium to the difference between a government guarantee and a corporate guarantee. If the government bond goes to 1%, that spread doesn't stay at 50. It obviously tightens to reflect the much lower yield of the government bond. And it might, ideally it would tighten in that perfect ratio, but it doesn't always work like that. It does work in reverse, though. If the government bond goes from 1 to 5, as we've basically experienced with a lot of bonds have risen in yield quite considerably lately, then those credit spreads do need to widen to re-establish that correct amount of credit premium. And then, as I said, sadly, when there are problems in that universe, it's kind of death by association for a lot of product, which is sad. And they don't tend to be very liquid at that point. And that's where a lot of people get jammed up with trying to build out, I guess, defensive sleeves in their portfolios. Obviously, I'm a government bond manager, and I try not to criticize credit too much because it's a great product and it should absolutely be utilized at the right points in the cycle. But it does have a tendency to behave a bit like equities at those real stress points. And you've only got to look back to what happened in March and April of 2020 or what happened at the end of 2018 to see that the proof is absolutely in the pudding with regard to the way those things perform. And that's why I guess what we do is important, because it does have that liquidity componentry that allows portfolios to have that optionality at that time. And I kind of remind people that there's not much point having a mobile phone with no batteries or a gun with no bullets. In those moments of real market stress, you've got to be able to get to the things that you want to liquefy in order to capture, your favorite growth assets that might be deeply discounted at that point. We had equities down 30 or 40% at the start of 2020, and that was just a total gift in some of these really good, strong corporations, and they've rallied all the way back and then some since that time. And so it's that dynamic asset allocation, which obviously we're interested in talking to folks about, making sure that they've got the right tools at their disposal to be able to achieve the things that they want to achieve in those moments.
If this situation goes completely sideways, how possible is it for credit markets to freeze up? I mean, are we heading down that road?
Well, it's happened twice in the last 4 years. I dare say that this one's pretty certain at some point. If we continue on, hiking rates the way that central banks are suggesting that we will, I'd say that that's pretty probable that we'll have a moment. I mean, what tends to happen in rate hiking cycles is that we hike rates until something breaks. And then when it breaks, we apologise profusely and say, I'm so terribly sorry, and we'll change policy to be far more supportive and accommodative. And then in providing that policy stimulation, it dampens the volatility, which allows people to get invested again, and the markets stabilise, and then they start to heal, and there's value everywhere. Now, that is the point at which credit does look very attractive as an asset class once you get those snap widenings, but you just don't want to get caught up with it as it's repricing to that point. It's an interesting one. There's a lot of publicly available literature on this that's been done by, kind of academic sources. Essentially, there's a fantastic one by the Norges Bank, which was written, I think, in 2016 or 17. And the reason it's very publicly available is when they change their asset allocation, it's got to be tabled through Parliament. The Norges Bank, obviously, is a $1 trillion investor. Thank you very much for all those, oil revenues, and they are obviously a very sophisticated institution. And they wrote a paper looking at asset allocation to say that if you only owned government bonds, of course you should own lots of corporate bonds. You do get a higher yield, and that makes perfect sense. But if you also own a lot of equities, actually what you're supposed to do is downweight your corporate allocation, upweight your equity allocation, and then barbell that by owning some more very liquid sovereign bonds of very particular nations. So you don't own any of the kind of more peripheral sovereigns. You just really focus in on, best in breed. And that's an interesting way to look at things. I guess, people often ask us about corporate credit and, our thoughts and how much should we hold. And when we're thinking about our fixed income allocation, how do we kind of balance that through sovereign, through credit, through high yield? then all these other types of products, whether we use linkers or do we use floating rates and all of these wonderful things that are available. Of course, there's been a huge rise in private debt, which is fantastic because it never gets marked to market. So it has very little volatility until it does. So there's all of these wonderful instruments that people can now use to solve their own investment needs. And that's a fantastic thing. And I guess that's been the evolution of the growth in the fixed income marketplace since we were running structural surpluses back in the Howard and Costello days, where we almost didn't even have a government bond market and we almost had no outstanding government debt. But we fast forward to today, and clearly, we've got more than $1 trillion if you combine up the federal and state, kind of debt, needs, and it looks like we're going to continue to have that structural budget deficit for quite some time.
So, as a bond manager, what are your return expectations as we move through these very uncertain times?
Yeah, it's a great question. Obviously, the markets have been moving at an unprecedented rate this year. It's been the worst performance for bonds since the year of 1980. And to say it's been the worst performance, it's been about twice as bad as that year was, and that's only year to date. So the sell-off has been extraordinary, and that's why we do worry for a lot of other things, further on down the line. Now, this is all kind of financialized to this point. It hasn't really hit Wall Street. It's hit Wall Street, but it hasn't really hit Main Street per se. But as I said, when the Federal Reserve hike interest rates very aggressively at the next few meetings, get us close to a 2% Fed funds rate by the kind of summer break. So say, July, clearly the RBA have got a lot to do and it looks like they're going to need to move a little faster. Then, it does become much more real as you open up your mortgage statements and realize that you've got to pay more to fund those borrowings that you do have. What we've kind of can tell you is that, at the end of every rate hiking cycle, whatever the terminal rate is, so whatever we get to, whether that's 2.5% or 3% or 3.5%, the 10-year US Treasury yield tends to be at or below that rate. And so what happens as we're hiking, obviously short-dated bond yields are rising, but in doing that and hiking and dealing with inflation expectation, longer dated bonds say, well, actually, if you're going to take inflation seriously, well, then that's a good thing. And then as growth starts to slow, they start to perform quite well. So we've already got pretty elevated yields, certainly from where we've come from. We've got, treasuries pretty close to 3%. Aussie 10-year bonds are over 3%. They're at, kind of three and nearly 3.25, 3.2. And so it's very unlikely that they will go materially beyond that, unless we're going to hike, central bank policies to those kind of levels. We think the economy will have not collapsed, but it'll be doing very poorly if that was to occur. That deals with the inflation issue very quickly by destroying demand, and it's probably unlikely they would realise, the full, gravity of that. Now, of course, if Australian RBA cash rates get to 3.5, that means mortgages are at 6. That's a hell of a way from 2, where a lot of people have been enjoying them. I just saw you wiggle in your chair a little bit. I think you might be a mortgage holder, as am I. So, clearly, and that it's going to change discretionary spending. And no one will argue with what happens to the economy under that kind of outcome. So it's about how much demand destruction do we need to pass on to the markets in order to get this inflation, problem to abate. It is a supply side predominantly inflation issue. So dealing with it via demand is not a perfect way to deal with it. But what does that mean for bond market returns? From here on, they actually should be a lot better. I mean, they've been terrible. But for instance, you can own bonds. They've got so much income in them now in terms of their yield that they are very investable through time. So just to give you an example, at the moment, US Treasuries yield short-dated US Treasuries, so 2-year bonds, which is a very popular kind of maturity that people would invest in. It's something that banks and insurers will invest in. If you buy a 2-year bond at around about 2.5%, you can own that bond to almost 4% by the end of the year without losing any money. So clearly the income componentry is so powerful for the balance of the year that even if the bond yield is to continue to rise, obviously you're having some capital slippage on the value of the bond at that time, but the income is so powerful that they negate each other. Now, obviously, if you hold the bond until it matures, you make 2.5%. So We are starting to see a lot more interest, in the bond market now that yields have risen. People have been very, very underallocated, and that's been the correct call. Obviously, bonds did a fantastic job of providing that liquidity and performance as we went into COVID, and government bonds were one of the only things that were really functioning at that time. And it meant that folks could go and buy, equities down 40%, saying goodbye to bonds at a gain. And they haven't held those allocations really since that time. And we are seeing a lot of investors coming back and rebuilding those allocations now. I think an expectation that, the market's repriced enough and it's very investable. I think they're also concerned that if we are to enact these very restrictive monetary policies, then we will have a recession. And I think that's, now very widely discussed that we'll almost certainly have a recession at the latter part of this year or early next year globally. Will it be mild or will it be severe? That's the source for great debate. It really depends on how much stomach do these central bankers have to continue to fight inflation if we have negative growth. And that's a much more challenging thing to do. It's easy to hike rates when everything's booming and everything's running red hot and employment's, sub 4%. It's a lot harder to do it when, things are moving in the other direction. People are screaming for jobs and it's a lot harder out there. And you clearly, need a lot more stomach to carry on and really kind of smash that inflation, bug with a very big hammer of monetary policy at that point.
So how do you, in a portfolio, when you're constructing a portfolio, how do you balance the mix of short-dated and long-dated bonds as rates change and as growth forecasts change?
Yeah, it's a great question. I guess, obviously bonds, you can buy very short-dated bonds that have only got a few months until they mature, all the way through in Australia to 30-year bonds. And, those bonds will perform differently at different points in that cycle. So, as we said, leading into these rate hiking cycles, the markets do tend to sell off. But from there on, the term structure. So what we're talking about there is when you sit down to Economics 101, obviously if you're lending money for a longer time, you expect a higher yield or a higher rate of return to compensate you for the extra time and the extra uncertainty that you'll have over that time frame. So you generally get a positively sloping curve. So that's to say that, 2 or 3 year bonds might yield 2%. Then you might expect that, 10 and 30 year bonds would yield 3 or 3.5%. And that's what we talk about, the term structure being 100 basis points steep, the difference between that 3% rate at the 10-year and that 2% rate in the shorter dates at the 2 or the 3-year point. Depending on where we are in the cycle, certainly, once we've started to hike interest rates, you do then probably want to own longer dated bonds because central bankers are dealing with that inflation expectation. Clearly, they sell off early because there is rising inflation expectation and they need to compensate to get to higher yields to compensate investors for that, higher inflationary expectation outcome. But once central bankers, deliver and they, stay credible to fighting those inflation expectations, you do want to be, allocated at those longer points. And so, that's when we talk about the curve flattening. And to your point, we did get to that curve inversion earlier, in the month in the United States, which has been the precursor to those recessionary environments. The shorter dated parts of the curve clearly very responsive to the central bank cash rate, and they really are the funding rates in anything that's floating or short term, any variable mortgage rates and those types of things. And so they're going to still be under sufferance for a little while longer whilst central bankers are completing on this process. But their total return, as I said, is a lot slighter than the longer dated instruments. So, and that's why we're very comfortable that the vast majority of any sell-off that we're going to experience has now occurred, because it doesn't really matter what happens to 1 year bonds. As I said in that illustration with the 2 year bond in the United States, you can buy them today at 2.5%. They could yield 4% at the end of the year. So they could carry on to sell off another 150 basis points. And from a total return point of view, you wouldn't lose much money. You actually might even gain a little bit. Now, that we couldn't get anywhere near those kind of levels before we had a credit event last time around. I dare say the world is even more uncertain this time around, given everything that's transpired. So, yes, whilst it's possible we could get to 4% rates, is it probable? I don't think so. I think, in the second and third derivative, a lot of things have changed markedly before that can happen. So, it doesn't really matter what happens to those shorter dated rates. Well, clearly, those much longer dated bonds, the 10-year bonds and the 30-year bonds, they have a much higher, sensitivity to change in terms of their own yields, in terms of the way that the bond value will change. But generally, once we start hiking, they become very stable, if not actually perform a little bit. Historically, you either want to buy them at and around the first hike, or certainly within kind of 6 months of the first hike. They don't really tend to sell off a lot more than there, unless we have a real stop-start hiking cycle, and that is possible as well. But generally, we've had a cycle which completes in one direction, it ceases, and then invariably, because it's damaged the economy in the process, they have to start cutting rates, and bonds obviously then perform incredibly well, as a lot of assets do. They enjoy lower funding costs, and we've all experienced that over the last 20 or 30 years. You've only got to look at somebody that bought a house 30 years ago, and they've made more money by going to sleep in it than they have by going to work. It's an extraordinary thing, but those falling long-dated interest rates have just lifted. That rising tide has lifted every asset, but it does work in reverse, sadly, and we're going through that in 2022.
So, Charlie, given where we are today, why should investors think about active bond funds versus passive?
Yeah, look, I think this is, again, a very contentious topic at all times. Look, active bond funds, clearly, they need to generate outperformance over time. You also want to kind of consider things like liquidity. So, for instance, in the March 2020 experience, a lot of the passive funds put enormous buy-sell spreads on their products because liquidity was obviously challenged in the markets. And so most of those funds, it was upwards of 100 basis points just to transact in and out of the fund. Whereas good active managers should be able to navigate that. We didn't change our buy-sell spreads. I think we were one of the only ones at that time, and certainly weren't trying to penalise investors for needing access to their money. That's absolutely what you've got to be. I mean, if you're a defensive asset, you have to be liquid at that point. The other thing that's interesting, just in the way that funds are offered, is that a lot of funds commingle sovereign government bond assets with corporate credit assets. And when the markets come under strain and we get that lockup in credit, the entire fund structure is put at risk. And so, again, we like to remind folks that segregating these different risk silos is quite important so that you can specifically target the allocation and the outcomes that you're looking for. But yeah, I guess, for our own funds, we have thankfully generated a lot of additional return and been able to offer those kind of moments for investors in March 2020 when they needed their money. For our own funds, we had to provide about $1.3 billion in a matter of days, and the markets were very strained. Credit had completely seized. Equities were down 30 or 35%, something at the time. Bond markets were still functioning, but they weren't functioning at all like normal, but they were still functioning. And, in the same way that they functioned through the GFC and through September 11 and through all these other chaotic events in history, assuming the settlement system is open, they stay open and they do function. And that's part of their appeal, that even on the darkest days, you can still get access to your defensive assets and have choices about how you might want to change your portfolios at that time. So, yeah, active managers, I think they've got a role to play. Obviously, what we're going through at the moment is a tough environment for everybody, and there's some pretty crazy things happening. I think, the fact that Australia is expecting more rate hikes than the United States is a classic example. I mean, that is just very unlikely to occur. I don't know anyone that really, hand on heart, believes the RBA will out-hike the Federal Reserve, but yet here we are. So, that does make it challenging at times to be an active manager. And I think, as an active manager, you've got to know when to take excess risk and that it's justified to try and make excess return. But you also need to how to control that risk. And if it's obviously a risk which is, very binary in nature, then we'd probably just avoid it and, would dial the risk taking down and wait till we've got, much higher conviction that we can add some value and generate excess return.
Digging a bit more into thinking around your funds, JCB has an absolute return fund. How do you treat that fund differently to your benchmark aware funds?
Well, it's all run off exactly the same process. So we only use sovereign government securities, but obviously with the index relative funds, they always hold bond allocations, even in years like this where it's been painful. But you hold them because you never know when a plane's going to fly into a building in New York, or there's going to be a nuclear accident in Japan, or something unexpected is going to occur, and at that moment you want to make sure that you've got something that zigs when everything else zags. With an absolute return fund, obviously, it's mainly about volatility targeting. So we're trying to offer a very low volatility solution to grind forward to obviously, generate stomachable and acceptable returns through time. And so we don't run that, kind of standing duration load that the fund offerings would have. Clearly, it should mean that it can have a much shorter investable window. We would absolutely say that with the index relative funds, if you look at the course of bond returns over time, they become very self-correcting. So actually, Merrill Lynch, Bank of America, wrote a fantastic piece after Brexit in 2016, which I'd make available to anybody that wants to kind of look at it. What it tried to show was what would happen to bond market returns if yields were to rise in exactly the same way that they fell for the following 30 years. And everybody immediately, without thinking it through, goes, "Oh, bloodbath, it'll be a disgrace, it'll be terrible." And of course, that's absolutely incorrect, because this is an income product. And as the incomes rise, it becomes very self-reinforcing. So the actual outcome for Australian government bonds over that 30-year period, if interest rates were to rise the same way that they fell, is a total return of 677%. Which is extraordinary. But at some stage, you get to 15% interest rates, which doesn't matter if bonds sell off a bit, it's still making a 12 or 13% return and compounding away on itself, year after year. So, with the index relative funds, obviously the investable horizon is suggested to be a little bit longer. Absolute return can be used to either dial down exposure. People have used it in substitution for term deposits, because obviously term deposit rates have been very low. Or they just like the fact that it's a really liquid fund offering. A lot of these absolute return funds do utilize a lot of corporate credit, a lot of low quality credit, or a lot of illiquid product. Mm-hmm. And they're all fantastic assets in a benign environment, but obviously in an environment where we are subject to more stress and strain, and I think 2022 is absolutely that year, then they can be not fit for purpose in terms of being defensive right at that time when you might need to utilize them.
Now, just to finish up with, Charlie, we have a couple of fun questions we always like to ask our guests. The first one being, what book has been most influential on your investment journey?
It would probably be Reminiscence of a Stock Operator, which is mainly about price action. It's an old book, and I read it a long, long time ago, but I am a big believer in price action, and that markets don't always necessarily follow the fundamentals. I guess you look at yesterday's CPI release in Australia. Initially, the bond market rallied very hard out of that. And that's just to kind of say, well, yes, since CPI is high, should that be bad for bonds? Yes, of course it is. But it was all in the price already. And so, similar to an equity that's expecting bad earnings, often you'll get the realization of those bad earnings and the equity price will rally. So I do believe that the price action is very important. I guess, with the performance of the bond market over the last few weeks, it does feel like it's finding its new levels, and we're not having those accelerated moves to higher yields that we've experienced for much of this year. We do have an awful lot, I guess, priced into the market. As I said earlier, we've got essentially full hiking cycles now priced to levels far beyond that, broke the markets last time round. So does that look overly generous? Yeah, arguably, yes, absolutely. Is this time different? Of course it is. We're not, facing these inflation issues that will require something quite significant in order to deal with them. But yeah, that book was amazing. It's a great read. It's an older book, but nevertheless, it's a good read for the Sun Lounger if you get a chance.
So the next question, you can be a bit brave here, or you can go the safe route. Tell us about your biggest gain or loss, and what were the takeaways from it?
Well, people always want to hear about the train wrecks, I guess. So back in the Fukushima nuclear accident, I had a very big loss. I was working in London at the time, and a client that I was working for put me into an enormous position. We used to do a lot of block trading. So, you'd take on really substantially large positions and work out of them on behalf of a client over time. I remember we were having a very, very tough day with regard to P&L, which is allowable in what I used to do. And it's obviously par for the course if you are going to take risk at times. And you realise that you work in these extraordinary environments. And I yelled out over the hood, does anybody here have a nuclear physics degree? And 3 people came to the desk and said, I actually do. And we had a very fast discussion about whether the core of that Fukushima plant would likely melt and how vast would this nuclear accident be. And we decided that we'd hold that position, and it ended up coming back okay for us. But it was a very large loss at one point. So that's certainly took a few years off the back end of my life at the time. And I was pretty certain I would be in a glass office having to explain myself to management. But thankfully, by virtue of working with a bunch of really special people at that time, we managed to get through it. So it was an interesting one.
And just finally, Charlie, you forged your career as a bond investor in 2001, working in the States in New York with Merrill. Since then, what have been the highlights?
Well, 2001 was obviously a pretty substantial low light. I just moved from New York to London just before September 11th. So it was the day I'll kind of never forget.
So you were there as the towers came down?
No, I was in London, but I had been in New York prior to that. Look, there's been a vast number of highlights and lowlights. I guess, for me, the GFC will always be, burnt into my psyche. I guess it's the, Mark Burgess, the chairman of our fund, says that every investor's psyche is kind of etched in the crisis of their youth. And so the GFC came along when I was in my kind of mid to late 20s, and it was always about liquidity and the lack of liquidity in markets. People thought they owned things that they could sell and be realised for cash, and it just turned out to not be the case.
What was Lehman weekend like?
Lehman weekend was pretty intense. We spent plenty of time in the office that weekend. That is a low light, obviously, but again, we managed through it. I was working in US Treasuries around September 11th, and we had to run all of the Merrill Lynch risk globally out of London, and I was brand new. I was just a kid, and we were printing out spreadsheets that would be bigger than the size of this room, trying to work out the net positions. And obviously, systems in those days weren't are not what systems are today. And so just, really thrown into the deep end in every way and having to, to kind of find a way through it. There were some kind of extraordinary moments. But, the great thing about these careers is they're very portable and they allow you to travel the world. And, I've had a very blessed career up to this point. I've been able to live in Tokyo and New York and in London and Sydney, now, of course, in Melbourne. It's a fantastic career in that regard that, you get to meet people all over the world, and it's very portable and you can travel with it. And I'd absolutely recommend it to any young person coming through that wanted to look at that. It's a fantastic industry to be in, and clearly a very critical industry, for time immemorial.
Charlie, a lot of this talk is very doom and gloom. How bad is it going to get? Like, is the music going to stop?
Look, I'm sorry that it is. I mean, unfortunately, 2022 is a difficult year. I mean, when we're withdrawing policy, it's not an easy time for markets. But investors should be comforted, I guess, by the fact that the expectations of the markets are that inflation will be dealt with, and that as much as we do need to hit the brakes to crush that inflation expectation at this point, thereafter the accelerator will come a little bit and things will normalise. And I don't think people should lose sight of that. But it is expected to be a volatile environment. And so for those that are dynamic asset allocators or active asset allocators, there's going to be lots of twists and turns that they can potentially monetize. For those that aren't, I guess it's diversification is always, the blessing. It means that, you've kind of got an each way bet for every outcome. And there's plenty of folks that like to have very concentrated positions at times and think they can read that and get all those twists and turns correct. But I think that, investors should probably be absolutely soothed by the fact that we don't expect rates are going back to 15% anytime soon. And as much as they need to go higher in order to deal with this moment, they're very likely to come down again thereafter. And that's a good thing, because for material credit delinquency, you need price and time. So everybody, it would be ordinary if you woke up to a 5% mortgage payment when you'd been paying 2%. But if it only happens, for a few months, then you can deal with it. It hurts. It stops you from having fun for a little while. But then if it goes back to 2, it's fine. If it stays at 5 for year after year after year, that has a very different impact on the way you behave in the economy, the way that the economy behaves. So as much as they're going to go up, they're very likely to come down thereafter. Hopefully it all happens fairly quickly, and this inflation issue is dealt with and does moderate, as many market participants do expect. And we don't have to go through the full, gravity of essentially what some of these bond markets are pricing in at the moment. But they are pricing in extraordinarily large moves. That is already in the current price. Now it's up to that realization phase, because everything that's happened has only been on expectation only at this point. But we are getting to that realization phase. We'll start next week with the RBA and the Federal Reserve. And as the rubber meets the road, we'll know a lot more about that and how it impacts the economy and how it changes the inflation construct fairly quickly thereafter. So, I don't. It's not all doom and gloom, but certainly, the way that things are lined up at the moment, it is a dangerous setup, and investors need to think that through and work out if they're positioned appropriately for what they, are expecting over the next little while. And if they're not, then they probably need to make some changes to be able to, ride those volatilities a bit better, and make sure they can still sleep at night.
Charlie, you've been very generous with your time. Thank you so much for coming on Rules of Investing.
Thank you very much for having me.